Hello, my name is Ben MacNevin and I'm an analyst with Montgomery Investment Management. I wanted to present today's video insight to remind our viewers that price should not be a focus when it comes to your investment decisions. To illustrate, let's take a look at the total return. So this is the share price movements and the reinvestment of dividends of each sector of the ASX 200 over the past 3 years. We can see that the best performing sectors have been healthcare and telecommunications. The healthcare sector has earned a total return of 170%, while the telcos have earned a massive 220% return. Conversely, the worst performing sectors have been materials and energy, otherwise known as resources. Over the past 3 years, these sectors have earned negative returns, and that's even after accounting for dividend reinvestment. Now, generally speaking, healthcare stocks and telecommunications companies provide goods or services that are in constant demand, regardless of what happens to the markets. As this chart demonstrates, this affords them with the capacity to earn stable returns over the long run. It's not surprising to see the underperformance of the resource sector, given the underlying weakness in the commodity sector. Management have no control over this. So as investors, this should demonstrate if you point your portfolio in the right direction by focusing on valuable companies, you can see it's not really difficult to outperform the benchmark simply because it comprises these lower quality sectors. So what does this mean going forward? Well, on a simplistic basis, if we look at this chart, we can postulate that some people may consider that healthcare stocks and telecommunication stocks have perhaps run too hard, and that the resource sector has been oversold. Invariably, there will be some people that trade with the expectation that mean reversion will occur. Or to put simply, you can buy stocks from the resource sector because they look cheap, and sell stocks in the healthcare and telecommunication sectors because they look expensive. Now, this will not change the way that we invest at Montgomery Investment Management, and it shouldn't influence the way you invest either. Just because a company's share price has increased doesn't necessarily mean that it's expensive, and just because it's fallen doesn't mean that it's cheap. A company's share price should only be considered in the context of its underlying intrinsic value. Value should be the focus, not price. So thank you for joining us this week. As always, follow us on Twitter and Facebook.